Welcome to your personalized deep dive into today's market moves. We're dissecting the EQAI Morning Briefing for November 1st, 2024. Think of us as your financial detectives sifting through the noise to bring you the insights that you need to make informed decisions. So are you ready to decode what's driving the market?
Absolutely, and it's a particularly interesting time right now. There's a definite sense of caution among investors, but also some intriguing opportunities emerging, especially when you look at how certain assets are performing. It's all about understanding the bigger picture.
Okay, so let's start with that market overview. Yesterday was a bit of a rough day, wouldn't you say? The S&P 500, Dow Jones, Nasdaq, even the Russell 2000, which tracks smaller companies, all closed in the red.
You're right, it wasn't pretty, and when we pull back and look at October as a whole, it was a challenging month for most asset classes. In fact, Deutsche Bank analysis shows that almost all of them posted negative returns.
So what does this tell us about investor sentiment? Sounds like people were getting a little jittery. Is there something specific driving this risk aversion?
There are a few factors at play, but a key one is this idea of a flight to safety. When uncertainty rises, investors tend to shift their money towards assets seen as less risky. Think of it like battening down the hatches before a storm. And this brings us to an interesting point. Even in a risk-off environment, there can be some surprising pockets of growth.
Oh, I like where this is going. Are you talking about those safe havens you mentioned earlier?
Exactly. For example, while stocks were down, we saw precious metals like gold and silver actually perform quite well in October. They often hold their value or even increase in price during times of economic turmoil.
So it's like having a bit of an insurance policy built into your portfolio. That's a good reminder that diversification is key, isn't it?
Absolutely. It's never wise to put all your eggs in one basket, especially when market volatility is high. Spreading your investments across different asset classes can help mitigate risk and potentially enhance returns.
Speaking of different asset classes,
Yeah.
let's take a quick detour into the world of cryptocurrency. The briefing mentions Bitcoin is down slightly, but Ethereum actually went up. What do you make of that?
That's a really interesting observation. And it's something worth watching closely. It could be a sign that Ethereum is gaining strength relative to Bitcoin, or it could just be a temporary fluctuation. We'll need more data to see if this trend continues.
So it's like watching a race unfold. Who's going to pull ahead in the long run? Only time will tell. Now let's shift gears and talk about Exxon Mobil. They're in the news today because their stock actually rose despite a revenue shortfall. It seems like a dividend increase they announced is giving investors some confidence.
That's right. You see, a dividend is a portion of a company's profits that they pay out to their shareholders. And when a company increases its dividend, it can be seen as a sign that they're optimistic about their future earnings potential.
So even though ExxonMobil didn't hit their revenue target, this dividend increase is like them saying, hey, we're still doing well and we want to reward our investors.
Exactly. And that can be a powerful signal, especially in a market where many companies are struggling. Think about it from an investor's perspective. Would you rather invest in a company that's cutting dividends or one that's increasing them?
That's a great point. Makes a lot of sense. It's about signaling long-term stability and commitment to shareholder value, even when there are short-term bumps in the road.
Precisely. And that brings us to another factor influencing market sentiment today, geopolitics. The briefing highlights that oil prices are on the rise due to reports of potential conflict in the Middle East. Specifically, there are concerns about Iran potentially planning a strike on Israel.
Okay, now this is where it gets really interesting for me. Geopolitics and the energy markets are like two sides of the same coin, wouldn't you say?
You're absolutely right. Geopolitical events can have a major impact on oil prices, which in turn can ripple through the global economy. In this particular case, the potential for conflict in the Middle East is creating uncertainty about oil supplies, which drives up prices.
And that uncertainty can make investors nervous, which might be contributing to that flight to safety we discussed earlier. It's like a chain reaction. But before we go down that rabbit hole, let's unpack this Middle East situation a bit more.
Of course. Now, it's important to remember that this is a complex situation with a long history. What's happening right now is the result of years of tension between Iran and Israel. Iran has been accused of supporting terrorist groups that threaten Israel, and Israel has responded with military action against Iranian targets in the region.
So this latest development, the potential strike, is like adding fuel to an already smoldering fire. It makes you wonder, how might this situation evolve? And what are the potential global economic implications if things escalate further?
Those are excellent questions, and they highlight why it's so crucial to stay informed about global events. Even if something seems geographically distant, it can still have a very real impact on your life and your investments. Remember, we live in an interconnected world.
It's a good reminder that we're not just investing in companies, we're investing in a complex web of global relationships and events.
Exactly. And understanding those relationships is key to making informed decisions. And that brings us back to the performance of specific sectors within the market. For instance, the tech sector had a rough day yesterday, with the Nasdaq, which is heavily weighted toward tech companies, closing down.
Right, and the briefing connects that decline to rising interest rates, which seems to be spooking tech investors. Can you unpack that for us a bit? How do interest rates actually affect the tech sector?
Sure. When interest rates rise, it becomes more expensive for companies to borrow money to fund their growth and expansion. This is especially relevant for tech companies, which often rely heavily on borrowing to finance their innovative projects. Higher borrowing costs can eat into profits, making those companies less attractive to investors.
So it's not just about cool gadgets and groundbreaking software anymore. Tech companies also need to demonstrate that they can manage their finances responsibly in a changing interest rate environment.
Exactly. And investors are paying close attention to earnings reports, looking for signs that companies are adapting to this new reality. They want to see strong profit margins, even with the headwinds of higher interest rates.
Now, in contrast to tech struggles, we have the energy sector. As we discussed earlier, Exxon Mobil had a positive day despite missing revenue expectations, thanks in part to their dividend increase. It seems like energy companies are benefiting from those geopolitical tensions we were talking about, particularly the situation in the Middle East.
Absolutely. Increased geopolitical risk often translates into higher oil and gas prices, which is good news for energy companies. However, it's not all smooth sailing for the sector. They face long-term challenges such as the global shift towards cleaner energy sources.
There's a bit of a balancing act. They're riding a wave of high energy prices right now, but they also need to be preparing for a future where demand for fossil fuels might decline.
Exactly. They need to be strategic about investing in renewable energy sources and adapting their business models for a changing world.
It sounds like a lot of industries are facing these sorts of transitions and challenges. What about the financial sector? The briefing mentions banks are facing pressure from regulations and the ongoing digital transformation of the industry.
The financial sector is absolutely in a state of flux. New regulations designed to prevent another financial crisis are adding costs and complexity for banks. At the same time, they're facing competition from nimble fintech startups that are offering innovative financial products and services.
So it's like the traditional players are being squeezed from both sides, more regulations and more competition. How are they responding to these pressures?
Well, they're having to adapt quickly. They're investing heavily in technology to improve their online and mobile offerings. They're also exploring partnerships with fintech companies to gain access to new technologies and customer segments.
It's interesting how these themes of adaptation and innovation keep popping up across different sectors. It's like everyone's trying to figure out how to stay ahead of the curve in this rapidly changing world.
And that's a crucial takeaway for investors. You want to be looking for companies that are not only performing well today, but also demonstrating the agility and foresight to thrive in the future.
So it's not just about chasing short-term gains. It's about understanding the long-term trends and identifying the companies that are well-positioned for those trends.
Precisely. And it's important to remember that those trends can be influenced by a whole host of factors, from geopolitics to technological advancements to shifts in consumer behavior.
It's a lot to keep track of, which is why having a resource like the EQAI Morning Briefing can be so valuable. It helps you stay informed and make sense of the complex interplay of forces shaping the markets.
Absolutely. The more informed you are, the better equipped you are to make sound investment decisions.
So we've covered a lot of ground today, from market volatility to the performance of different sectors to the impact of geopolitics on energy prices. As we wrap up this deep dive, what are some key takeaways you'd like our listener to walk away with?
Well, I think the first takeaway is that market volatility is likely to persist in the foreseeable future. We're living in a world where uncertainty is the norm, and that's reflected in the markets.
Right, so it's not about trying to avoid volatility altogether. It's about learning to navigate it effectively.
Exactly. And that brings us to the second key takeaway, which is the importance of diversification. Spreading your investments across different asset classes can help mitigate risk and smooth out returns over time.
And as we discussed, that diversification might include considering assets like precious metals, which often perform well during times of uncertainty, just like we saw in October.
Precisely. Gold and silver have historically been seen as safe haven assets, and they can play a valuable role in a well-balanced portfolio.
So while navigating the markets can feel a bit like riding a roller coaster at times, There are strategies and tools available to help you stay on track and reach your financial goals.
Absolutely. The key is to stay informed, stay adaptable, and never stop learning. There's always something new to discover in the world of finance.
It feels like we've been given a lot to consider today. Is there anything else you think we should highlight before we wrap up?
I think it's worth reiterating the point that even in a volatile market, yet with global tensions and economic uncertainty, there are still opportunities out there. It's about being informed, discerning, and perhaps even a little bit adventurous.
That's a great point. It's easy to get caught up in the headlines and feel overwhelmed by all the negative news, but as we've seen today, there are always bright spots and potential for growth if you know where to look.
Exactly. And that's where platforms like EQAI can be incredibly valuable. It helps you cut through the noise and focus on the information that's most relevant to your investment goals.
It's like having a personalized roadmap for navigating the financial landscape. It points out the potential pitfalls and highlights the paths that might lead you to your desired destination.
That's a great analogy. And remember, every investor's destination is different. What matters most is aligning your investment strategy with your individual goals and risk tolerance.
So as we leave our listener to ponder all of this, what's one final thought you'd like to impart? Something to really get them thinking about their own financial journey.
I would encourage you to think about how all of these global trends and market movements connect to your own personal financial goals and interests. Are you positioned to weather the storm of volatility? Are you taking advantage of emerging opportunities? These are the questions I encourage everyone to explore as they chart their own course in the world of finance.
That's fantastic advice. Thanks for joining us today for this deep dive into the financial markets. Remember, stay curious, stay informed, and never stop learning. Until next time, happy investing.